Welcome to TheoTrade. This is Don Kaufman. It's February 3rd, 2020, and you are watching the TheoTrade evening video. We've got about 13 minutes to go to the cash close with the S&Ps up some 25 points. But I got to tell you, in the midst of some of the volatility that we've seen really over the last week of trade, the S&P being up 25 means very little. Again, the question that just looms inside of this market right now: are we looking for like a full-fledged rally back or more sell-side activity? And I'm going to try to bring that into scope right here, right now. Before I dive into that, I am more than aware, of course, that Google has an earnings announcement. But frankly, in light of everything that we've seen over the last week or so, I'll tell you, the earnings, okay, I've kind of pushed them aside a little bit here. We're still hitting a lot of earnings butterflies, and I detailed a bunch of butterflies last week on a number of videos. But again, here on Google, I'm less inclined to spend time on one individual product when right now, I'm telling you, it's all about high states of correlation. And that effectively means like the market is moving as a whole. When you start to look at things like the S&P 100, I mean, this morning, the S&P 100 advanced decline line, every single stock was up pretty much the cash open, and we've slipped a little bit. But it's all about high correlation coefficients, which effectively means let's not necessarily worry about one individual underlying like a Google that happens to be up some $45, $46 here. Even before their earnings are out, boy, they better hit or they are going to get punished. Again, much more importantly, let's break down the marketplace and why I say, like, are you looking for us? And let's cruise over here to the spiders, bring up the spiders, a little bit of a longer term chart. Are we looking for just what? A straight rally right back up? Or are we likely to see more sell-side activity? Now, before I even detail into this, what I'm going to display to you right now may very well sway your opinion. Nevertheless, even as the marketplace is coming to a close, today's trading session, you can see the S&Ps coming off. Again, be aware what you're about to see may very well sway your opinion one direction or the other. With that, let's get down to it. First and foremost, when you look at the S&Ps, something's not right here. And when I say something is not right, okay, there are a few real standouts here that are going to lead us to believe, okay, there's going to be a lot more volatility this week. Not, necessarily tomorrow. Sure, we could, have some follow-through rally tomorrow because of an instance of Google having spectacular earnings. But again, push that aside. When you look in the bigger picture of this week, you're going to see a lot more volatility. When I say something isn't right over here, you got the S&Ps up some 22 points. Volatility hasn't dropped. Okay, volatility just hasn't dropped. And I really want to dig into this for a second, because why am I so critical about volatility not dropping? Because on Friday, you saw a pretty hideous down day in the S&Ps, right? On Friday, the S&Ps were down, okay, roughly about 62 points. So they were down 62 points. And the volatility futures specifically, they really took off to the upside. And the things about the volatility futures, though, to know is that volatility futures usually kind of overshoot and then pull back the next trading session. Well, here we have a trading session, people, where the S&Ps are up 22. Volatility is barely down. Okay. And for those of you that don't speak volatility futures, maybe you speak the VIX. The VIX is down a negligible amount. Again, these volatility futures are barely off at all, and the S&Ps are up 21. That's why I say you have to almost discount any rally back off your 20 points. What does it mean? It means absolutely nothing in the midst of volatility. So that's point number one. And we can further that a little bit with looking at like the VVIX. That's the volatility of the Volatility Index. Okay, it was and traded down and bounced back up throughout the course of the day. So the risk is actually coming back into favor as this day has actually progressed. So let's say volatility is one of the reasons that we're probably going to see some more sell-side activity. It is basically stating right now, trust nothing you see on this screen. Number 2 point that I want to make has to be the bonds. Okay, the bonds, listen, they haven't backed off an inch. Okay, the notes, all right, the notes are down a whopping 3.5 ticks in the day, but they haven't backed off. Effectively, the entire professional world is saying one thing. Okay, trust nothing. That's what they're telling you right here. Look at the bonds. Okay. I mean, listen, if this marketplace was just going to rally right back up, these rates probably would have popped back to the upside, back to 1.6. But instead, we're headed closer right now to 1.5 on the 10-year. It's crazy. Okay. With those, and again, maybe we don't just want to look at volatility futures. Maybe you don't necessarily want to look at bonds. Great. Go look at junk. Why would I bother looking at junk? The marketplace, if it was going to bounce back up, everybody would feel warm and fuzzy inside of junk again, because we're only 2 weeks removed. And remember, I did a video about 2 weeks ago and I said the market has gone completely and totally nuts. They're buying junk like it's going out of style. All right. That was like 2 weeks ago. And now you see the damage that's been done to junk. Okay. You should see a big bounce, though, back to the upside in junk if, again, this marketplace, if we're ready to sound the all clear. So evidently, we're not sounding the all clear in terms of the volatility. We're not sounding the all clear in terms of the bonds. We're not sounding the all clear in terms of junk. Okay, junk is still bonds over here. Where else could we actually look? I believe that we should actually look over at the XLU. The XLU, which is the utilities. Okay, they're buying them right now. Why? It's a good question. Maybe they're buying them because you can make an argument that there's a rally going on. I disagree. I believe that they're still buying utilities right now because there's fear. And the utilities are not dissimilar, okay, to what the bonds happen to be. And why? No, because the utilities right now, they're paying still a 2.9% dividend, which doesn't look half bad, okay, when we just looked at the 10-year a moment ago. And what did the 10-year say? We're closing in on 1.5%, people, on a 10-year. So the reflation trade, once again, is dead. Everybody's just, yield hungry animals out there. Now, we looked at utilities. This could be risk on, kind of risk off. We looked at bonds. Bonds absolutely point to more risk. We look at volatility. Okay, the S&Ps are obviously trading a little sketchy. Clearly, though, a lot of people look at the NASDAQ. And the NASDAQ, I can't argue that. The NASDAQ is actually ripping to the upside. Okay, as the NASDAQ rips to the upside, how come the S&Ps aren't following suit? Well, because of those bond markets, you're actually getting weakness inside of the financials. If you miss this, all right, you're missing the bigger picture over here. I'm always so centric of what these financials are doing. I mean, the financials, these things traded all the way to 30.46. Talk about a fade. These things just keep selling into the cash close over here. So the financials got really weak. Okay, they're actually dragging the S&Ps down. You've also got energy, and energy has just been getting absolutely unequivocally pummeled. Now, here is, people are asking a little bit about all right, talk a little bit about the coronavirus trade. Here it is. Okay. This is the coronavirus trade right now that is actually decimating many of the energy companies. Energy consumption and global oil consumption is apparently going to be down and down substantially. So they are just beating up day in and day out on the energy sector. Neither here nor there. The issue is, though, that the energy sector, even though it's a small area inside of the S&Ps, it's still providing pressure to the overall S&Ps. So at the when you have energy down day in and day out, it's just weighing on the S&Ps. All right. So not even the monsters of tech, and the monsters of tech today, they're up 1.2%. That's that complex that includes Facebook and Apple and Microsoft and Google and Amazon. I mean, the thing is up like 1.2% today, and not even that is really sustaining, much of the marketplace. Last but not least, what I would also caution you about, you have some heavy market cap that's just leaning to the downside. Amazon, neither here nor there. Listen, Amazon doing just fine in the $2,000 range here, which it continues to effectively be in. It's down nominally today. What concerns me, though, things like Caterpillar, which is on a really slippery slope to the downside. Obviously, China having a larger impact over here. Costco, again, heavy sell side activity persistent in Costco in the last couple of trading days. Boeing, which hasn't been able to get out of its own way lately, did okay on earnings, but looks to be slipping back to the downside. Again, we can point out a number of key areas that still lead us to believe, that absolutely more sell side activity, is going to be present throughout the course of this week of trade. Don't be surprised to see pops and drops, on a day-to-day basis. Pick your entry points, sell those rallies, but use define risk trades like in-out spreads. Okay. When it comes to upside opportunity, the same thing is true. After some big sell side activity, we may actually step in with a couple of in-out spreads. This is just going to be what? Fade the bounce, fade and trade, in-out spreads, define risk. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.